best friend in the world has 5.19% of her fund in Teladoc. This is my friend Kathy Wood. This is sarcasm. If you do the show, I'm Paul. I'm a value investor. Kathy Wood hates value investors until her stocks fall. Then she says they're in deep value territory, and then she sells all of them because she doesn't get investing. So I'm here to talk about Teladoc. Teladoc is plummeting after hours. They were expected to do $586 million in revenue. They ended up beating that. This is their press release about the company. They ended up doing, if we scroll down here, $592 million in revenue. Last year did 503, an increase of 18%. They lost $3.1 billion, but $3 billion of that was an impairment charge on something, which I'd look into about what they wrote down. So they lost $101 million without that impairment charge. And there are other things that were involved, like compensation, et cetera, that probably, I heard from somebody that went the positive a little bit, okay? So Teladoc is let's pull it up in our software here real quick, because my goal is to teach you that you are buying a company. When you buy a stock, you're buying a piece of a business. Kathy Wood does not understand this. She believes you're buying a story and that's it. This is why Kathy Wood's fund hit a high of 160 and now has crashed down. And mark my words, she will be retiring in the next few years, but claiming some other reason other than the massive failure of her funds. She's a terrible investor. She has no idea what she's doing, and you should avoid her like the plague. Now, look at Teladoc here, guys. In the last year, hit a high of 156 and a low of $27. It's currently after hours, $37.32. Okay? So that's pretty awesome. Its market cap is $7 billion. Now, the price to sales ratio isn't bad, 3.2, but everything else is pretty rough. We usually do what's called an 8-pillar analysis. We can't really do that here because you need to have some sort of, our software is great for companies that make money or have some sort of history. Look at this company. They did $9 million in revenue in 2014, and they did 2.14 last year, not including this year, billion in revenue. That's a lot. That's amazing growth. And Kathy Wood saw this and said it's only going to the moon. Okay? I just don't believe that. So let's go look at their chart real quick. What's their max chart? In July 1st of 2015, they were at $28 a share. July 1st of 2015. In 2015, they did $50 million in revenue. So if I told you in 2015 that the company did $50 million in revenue and they would do $2 billion in 9 years, would you believe me when I said their stock would be almost flat? You'd be like, you're crazy. That's what overvaluation does. Let's look at their shares outstanding. They had 27 million shares outstanding when they went public. Now they have 160 million. So 5 times more shares. That should scare the bejesus out of everybody here. I don't blame them for doing that because their thought was, oh my God, our company doesn't make money. It's overpriced. These crackheads out there who are obsessed with us, like Kathy Wood, will buy anything we give them. Let's just sell them shares instead of taking on debt. I would absolutely do that. That's the smart move, but it's diluting you as an owner. If you owned a share back in 2014, your current share buys 1/5, 80% less of the company than it did before. Think about that for a second. Actually, it's worse than that. It's almost 6 times. It is 6 times, 1/6 of 16% of what you would have bought before. That's terrible. So what do we do from here, guys? Look at this company. It lost $6.9 billion last year. It has never made money. It has never made money. Now, does that mean you should avoid it? Well, no, a lot of companies don't make money when they're first starting out. This is 8-9 years into it. It's a $7 billion company. Your job will be to figure out how are they going to make money and are they close to doing it? They are diluting the heck out of everybody. Let's go see their balance sheet. Let's see how their debt looks. Okay, not a lot of debt. That's good. They have $1.2 billion in cash, 1.95 in total liabilities, 1.6 in long-term liabilities. This is a speculative play. If you really want to buy this company, you have to be able to build some sort of model of how it's going to make money. Because right now they're not making money. So how can they make money? I believe after you take out all of their extra expenses, they made money this quarter. But, you know, that's kind of like an excuse for things. A $3 billion impairment charge. Let's go see what it was about. A non-cash goodwill impairment charge. They say non-cash. This is non-cash this quarter. But they paid the money at some point before. Now, that could be a fluke. But for them to lose $6 billion last year, they must have had some sort of other impairment charge. at some point. So let's go to the income statement. Yeah, right here, special income and charges, 6.66 billion. So guys, last year and this year, they've written off $9.7 billion. And oops, we made a mistake. Guys, Cathie Wood owns the stock. Cathie Wood's a terrible investor. Just from that alone, it makes me laugh about it, saying I probably would avoid the stock just for that. But do your own research. Understand that. But I don't see the path of profitability here. I'm sure if I talk to somebody at the company, they'll tell you they're right in the cusp of major profit, et cetera, which, by the way, I bet you've listened to all their calls going back to here. They're probably saying the same thing. Oh, we're on the cusp of major profit here. I'm sure they said it all along the way. And then you'd have this, and I'm speculating here, but that's what companies do. Everybody talks about how they're so close. They're so close. This is a tough play. This is a speculative play. I want you to look at every investment as the present value of all future cash flow. When you buy a stock, you're buying a piece of a business. And separate the stock from the company. You need to separate them because you need to understand that they're totally different things. You can have a phenomenal company, great prospects, awesome, and if the stock is overpriced, you are wasting your time and money. You are hurting yourself. So please don't do that. If you like what I've said so far, please subscribe to the channel. We do 3 or 4 videos a day. It's incredible. Join our community to meet thousands of other like-minded investors who use our software back here to make better decisions on their investments. It's less than a cup of coffee per day. This is a no-brainer, guys. Go to everythingmoney.com. In the meantime, please subscribe to the channel. You're going to love it. It's going to change your life. Thank you very much.